Imagine here's the thing. Markets don't always move because of news. Sometimes they move because of levels everyone is watching, even if they won't admit it. What if I told you that the real story behind 65 and that brief push to 67 isn't about where silver is going next, but about how modern markets react when long-held assumptions get tested? That's the part most people miss, and it changes how you look at price action entirely. In this video, we're unpacking why the 65 area mattered, what made the move towards 67 grab so much attention, and why moments like this often trigger what traders sometimes call Monday mayhem. Not as a prediction, and not as a trading signal, but as a case study in market structure, psychology, and history. In a time of persistent inflation debates, shifting monetary policy, and growing interest in real assets, understanding how silver trades, not just what it trades at, matters. My goal here is simple: give you context, history, and tools to think more clearly about what you're seeing on the screen. To understand why levels like 65 or moments like a push towards 67 attract so much attention, it helps to zoom way out, sometimes centuries out, and look at how silver has functioned inside monetary systems over time. Because here's the thing. Silver wasn't just another commodity for most of recorded history. It was money, or at least part of the plumbing that made money work. If you go back to ancient Lydia around the 7th century BCE, some of the first standardized coins were made from electrum, a natural mix of gold and silver. By the time of classical Greece and later the Roman Republic, silver coinage had become central to trade, taxation, and military pay. The Roman denarius, introduced around 211 BCE, was almost pure silver at first. For generations, it functioned as a trusted unit of account across a massive empire. But over time, pressures built. Wars got expensive. Bureaucracies expanded. Taxation had limits. And that's where a recurring historical pattern shows up: debasement. Roman emperors gradually reduced the silver content of the denarius. By the 3rd century CE, under emperors like Caracalla and later Gallienus, the coin still looked like silver, but its actual silver content had fallen dramatically, in some cases to under 5%. Prices rose. Trust eroded. People began demanding more coins for the same goods. The issue wasn't inflation, as a headline, but confidence in money itself. This pattern repeats because it's not about silver specifically. It's about human systems. When money is tied to something tangible, whether silver or gold, it imposes discipline. When that discipline becomes politically or economically uncomfortable, systems tend to loosen it. Sometimes slowly, sometimes abruptly. Fast forward to medieval Europe and you see similar dynamics. Silver pennies dominated commerce for centuries because gold was too valuable for everyday transactions. But whenever rulers clipped coins, reduced weight, or altered purity, markets noticed. Gresham's law, often summarized as "bad money drives out good," wasn't just a theory. People hoarded higher quality coins and spent the debased ones. Sound familiar? Now jump ahead to the modern era. By the 19th century, many countries operated under bimetallic standards, where gold and silver were both legal money at fixed ratios. The United States did this formally with the Coinage Act of 1792. But fixed ratios created problems when market values shifted. If silver became cheaper relative to gold, silver coins flooded circulation and gold disappeared. When silver became more valuable, the opposite happened. The system was always under tension. That tension culminated in key transitions. In the US, the Coinage Act of 1873, sometimes called the Crime of 73 by its critics, effectively demonetized silver. This wasn't a conspiracy so much as a response to global trade realities, but the backlash tells you how important silver still was to ordinary people, especially farmers and debtors. Silver wasn't just metal, it was access to liquidity. The 20th century accelerated everything. After World War I, Weimar Germany offers one of the clearest examples of what happens when monetary discipline collapses entirely. While silver wasn't the unit of account there, the lesson matters. As the mark lost credibility between 1921 and 1923, people fled paper claims and rushed toward tangible goods, foreign currency, and precious metals. Prices didn't just rise, they disconnected from reality. Again, not because metals magically create value, but because trust in money was breaking down. Then comes Bretton Woods in 1944. This system pegged currencies to the US dollar and the dollar to gold at 35 an ounce. Silver still circulated in coins in the US until the mid-1960s. But mounting deficits and overseas dollar claims made the system fragile. By 1971, the Nixon shock ended dollar-gold convertibility. From that point forward, all major currencies became fiat, backed not by metal, but by government credibility and policy. This is where silver's role subtly changes. It stops being official money, but it doesn't stop being a monetary reference. It lives in a hybrid space, partly industrial, partly financial, partly historical memory. That dual identity is crucial. Silver demand doesn't just come from investors or collectors. It comes from electronics, solar panels, medical applications. But its price behavior often reflects monetary stress, liquidity shifts, and changes in confidence. Historically, periods of high monetary expansion, negative real interest rates, or currency uncertainty have coincided with renewed attention on metals. Not as guarantees, not as shields against every outcome, but as benchmarks, as signals. as reminders of what money used to be anchored to. So when modern markets fixate on specific price levels, it echoes this long history. Those levels aren't magical. They're psychological and structural. They represent points where expectations collide, where assumptions about liquidity, supply, and demand get tested, and where the past quietly informs the present. That historical lens doesn't tell us what will happen next. It tells us how humans tend to behave when money systems are under strain. Now that we've grounded ourselves in history, let's bring this forward into how the silver market actually functions today, because this is where a lot of confusion comes in. Most people see a price on a screen and assume it represents a simple supply and demand balance for physical metal. In reality, that price is largely discovered in paper markets, not in the physical market most people imagine. The primary venue for silver price discovery is the futures market, particularly COMEX. Futures contracts are agreements to buy or sell silver at a future date, and the vast majority of these contracts are never settled with physical delivery. They're rolled over, closed out, or netted against other positions. This doesn't make them illegitimate. Futures markets exist to provide liquidity and price discovery, but it does mean that a relatively small amount of physical metal underpins a very large amount of trading activity. Alongside futures, you have exchange-traded products like ETFs. Some are structured to hold allocated physical silver, while others rely more heavily on authorized participants and custodial arrangements. The details matter. Allocated means specific bars are set aside. Unallocated is more of a claim on a pool. Most investors never read those distinctions, yet they affect how physical demand translates, or doesn't translate, into price movement. Then there's the physical side itself. Global silver mining output is relatively inelastic in the short term. You can't just turn on a silver mine because price moved this week. Most silver is produced as a byproduct of mining other metals like copper, lead, and zinc. That means supply decisions are driven by broader industrial economics, not silver alone. On the demand side, industrial use has grown steadily, particularly in electronics and solar applications, where silver's conductivity and reliability matter. This creates a baseline level of consumption that doesn't respond quickly to price changes. Investment demand sits on top of that. Coins, bars, and small denomination products often experience shortages or high premiums even when the quoted spot price is stable. That disconnect can be confusing. It doesn't mean the spot price is wrong. It means different parts of the market respond at different speeds and under different constraints. Overlaying all of this is the macro environment. Inflation readings, interest rate policy, and currency strength influence how participants position themselves. When real interest rates are low or uncertain, non-yielding assets like silver tend to attract more attention. Again, not as a promise of returns, but as an alternative form of exposure. Institutional participants, meanwhile, often use silver as a hedge, a trade, or a portfolio diversifier rather than a long-term holding. This is where moments like a move from 65 toward 67.3 become interesting. Not because they predict anything, but because they test assumptions. They can force short-term repositioning, trigger margin adjustments, or expose where liquidity is thinner than expected. The mayhem isn't chaos. It's the market revealing how it's structured. Understanding these mechanics helps you watch price action with a calmer, more analytical lens. Instead of asking, what does this mean for tomorrow? The better question becomes, what does this reveal about how this market actually works? Once you understand both the historical role of silver and the way the modern market is structured, moments like this start to look very different. Instead of feeling like random volatility or something to react to emotionally, they become signals of stress, adjustment, and information flow inside the financial system. Not warnings, not forecasts, signals. One important implication is how price action can influence broader conversations about purchasing power. For most Americans, inflation isn't an abstract statistic. It shows up at the grocery store in insurance premiums, housing costs, and energy bills. When assets tied even loosely to monetary history begin drawing attention, it often reflects a wider unease about what money buys today versus what it bought 5 or 10 years ago. Silver doesn't cause that concern. It mirrors it. Another second-order effect is educational. Episodes of sharp movement force people to ask better questions. Why does the quoted price move faster than physical supply? Why do premiums behave differently from spot prices? Why does industrial demand matter just as much as investor interest? These questions push viewers beyond headlines and into systems thinking, which is where real financial literacy starts. There's also a behavioral layer worth noticing. Modern markets are dominated by algorithms, passive flows, and leveraged products. When prices approach well-known levels, those systems respond automatically. Stops get triggered. Positions get rebalanced. Volatility clusters. From the outside, that can look like mayhem, but from the inside, it's mostly plumbing. Understanding that helps separate emotional narratives from mechanical realities. For individuals watching from the sidelines, the most valuable takeaway isn't about silver at all. It's about perspective. Moments like this invite questions such as how much of today's financial world is built on leverage? How dependent are prices on confidence rather than cash flow? How well do I understand the difference between a claim on an asset and the asset itself? These aren't questions with one right answer, but they are worth asking. There's also a broader economic implication tied to trust. Fiat currency systems rely heavily on credibility, consistency, and policy communication. When that credibility feels uncertain, attention naturally shifts to benchmarks with long memories, not because they're perfect, but because they're familiar. Silver, with its mix of industrial necessity and monetary history, sits right in that overlap. What matters most is resisting the urge to turn these observations into conclusions. This isn't about assuming outcomes or drawing straight lines into the future. It's about sharpening awareness, watching how markets behave under stress, noticing where narratives break down, and understanding that volatility often teaches more than calm periods ever do. If Part 1 gave us historical humility and Part 2 gave us mechanical clarity, Part 3 is about intellectual posture, staying curious, staying grounded, and recognizing that knowledge, not reaction, is what actually builds resilience in an uncertain economic landscape. Let's bring this together. We looked at silver's long monetary history and how repeated patterns of debasement and transition shaped its role. We examined how today's silver market actually functions, with paper markets, physical constraints, and institutional behavior all interacting in ways that aren't obvious from a price chart. And finally, we explored what moments like this can teach us about purchasing power, market structure, and economic awareness without turning them into predictions. If there are a couple of takeaways to hold on to, it's this. First, price levels matter less than what they reveal about market mechanics and psychology. Second, silver isn't a crystal ball. It's a lens, one that reflects stress, confidence, and structure inside the monetary system. And third, understanding these dynamics puts you in a stronger position to interpret headlines calmly and critically. If this perspective resonates, hit that like button. It tells the algorithm and me that this kind of deep, educational breakdown is worth continuing. Drop a comment and let me know which part you found most useful, the history, the market structure, or the broader implications. And if you want more content like this, subscribe. Every week, we dig into the patterns behind money, markets, and economic behavior. And if you want to go deeper on how physical versus paper markets really work, check out the next video on your screen. It builds directly on what we discussed today.